Reasonably confident that the ingredients are now in place to bring inflation back to the 2% target.
The Bank of Canada announced a second key interest rate cut last week, dropping its benchmark rate by 0.25%. And that small cut could make a difference when it comes to your mortgage. Joining us now for more, Peter Sashecki with Everything Financial. Thanks so much for joining us this morning.
Good morning.
All right, walk us through this. Overall, how is the interest rate reduction actually affecting mortgages, or how can it?
Well, the big ones it affects right away are people who have home equity line of credit. So that 0.25% comes right off the top right away. Or if you have a variable mortgage. So on the home equity, it could be prime up to roughly prime plus a half. So that goes down. The variable mortgage, depending when you got it, could be prime minus. So those rates go down. Everyone's concerned always and loses their minds over the 3, 4, 5-year rates and how is that affected. And there was minor effects in that. So they dropped a little bit in some cases, but the bond valuators had already, priced that reduction in the interest rates into the current mortgage rates. So the big effect will be when the next rate cut comes.
And when we're talking dollars and cents with all of this, what difference would a rate cut like this actually mean for those monthly payments?
Well, in a place like Saskatchewan, it'll be a few dollars to your mortgage, but where the size of the mortgages are in the lower mainland.
Fair enough.
In many cases, you're seeing $300-400 differences to those floating interest rates. So it can make a sizable difference to your mortgage, but every 0.25% does make a big difference.
Yeah, and of course, the difference to the bottom line, how much we're shelling out every month. Now, the impending mortgage renewals, how much do they influence the Bank of Canada's decision when they're looking at the rate cuts?
Well, I think overall, it should influence it. It doesn't really, but the thing is there's so many mortgages coming due over the next year that the way they're now, with the changes the government made 14 months ago to the way they calculate inflation, by now adding 2 more factors in, kind of double dipping on the inflation numbers, it really causes inflation to go up. So by reducing the mortgage rates, those renewals will have less impact on inflation than they would with a high interest rate. So the lower they go, the better it's going to be for people.
What affects long-term rates?
The bond valuations. So the bond valuations and the bond valuators, as those go down, then the 3, 4, 5-year rates, 1-year rates and 2-year rates even, those go down as well. So if we can get those bond rates to go down, then the mortgage rates on the locked-in stuff will go down. So do not lock in right now. The bank calls you and says, oh, you better lock in. They're not really going to change. Well, someone is either misinformed or just not giving fully transparent story, because as rates go down, those mortgage rates are going to go down if interest rates go down, for sure.
Where were you in May when I re-signed my mortgage?
Did you sign for 5 years?
Just 3.
3 should be okay. You'll be all right. The last year you'll be a little painful, but in the end you'll be okay.
Okay. And where do you think the rates are going next, if you had that crystal ball?
Well, the crystal ball person I talked to, who lives on the other side of the country in the center of Canada in Ottawa, they target roughly 3 more at the end of the year, and some people say no more, but the backhauls say probably 3 or 4 more. But possibly even 1.5% between now and next October. And there's something going on next October. Election or something like that? I don't know. I haven't heard anything about it. But between now and then, they say possibly even up to another 1.5%. Inflation really is the key factor. If inflation stays low, keeps going low, then you've got to bring the interest rates down to work well with the inflation reductions. And that's what we need, is inflation to stay down and then interest rates follow.
All right, some great advice. Thanks so much for spending some time with us this morning, Peter. That's Peter Sashecki with Everything Financial. Thanks.
Thank you.